Hey everyone, today I would be breaking down the financial analysis of Summit.co. It's basically a luxury travel package company, and my goal is to use a financial analysis to determine if this company or this project should be invested or not. And we would be using various financial tools like NPV, WACC, payback period, and different investment appraisal method. So we're going to this slide 2. That's our agenda. So what we will cover? We'll cover executive summary, that would be key finding and financial highlights. Then we will be moving on to the company introduction. Then we will look out to the number. What does number say? Is it a good investment or is it a bad investment? And also we would be looking this by various three methods that is listed out. That is WACC calculation. Then we would be checking its cash flow. Then we would be going to the its NPV. NPV is net present value in both payback period and then historic payback period. And then lastly, but not the least, we would be finalizing the decision. Should we go or not? Okay, so now going to the third slide, that is executive summary, and I would bring you a quick snapshot of our key findings. So project lifeline is for 5 years, and the investment required for the project is 6.05 million. And as we can see, NPV calculated at 7.14 percentage, that is 2.79 million. That is really profitable. But NPV calculated at historic rate is less attractive because it's only 519,000, which is less than the 2.79 million. Still, it's profitable, but it's less attractive. And then we would be looking out the simple payback period, that is 3 years and 0 months. Then the discounted payback period, that is 3 years and 8 months, and discounted payback at historic, that is if we calculate at 18%, that is 4 years and 7 months. So after 4 years and 7 months, we're going to receive back out the investment that we're doing of 6.05 million. Moving on to the introduction part, let's go to the company overview before driving on to the numbers. Who is this? And let's understand the business. So, this is a small case study. Imagine you're standing at the base of Himalayas. You've got a vision, a luxury travel package that you could redefine adventure tourism. I'm talking about the same project, Sumit Trials Scope. It's a luxury adventure travel company specializing in premium Himalayan expectation. So these luxury travel package includes helicopter tours, luxury accommodation, and personalized service according to your individual personal needs. Now, this really sounds crazy and fancy, but let's look out the math and let's dive into the numbers. So let's check using different financial tool is this investment worth? Going to the next slide, WSCC, that is the cost of capital. So before investing companies, we need to know the cost of money, and WACC is the same. WACC is just like the interest. It's like the cost that you have to bear to take the capital. So WACC for Sumit Trial Co is breakdown into cost of equity is 6.67, cost of debt post tax is 2.38, equity weight is 7.43, debt weight is 28.57, and final WACC. So how gonna we calculate final WACC? WACC is nothing but the sum of cost of equity plus cost of debt. And when we take the average, so our WACC coming out is 7.14%, which talks about 7.14% is the cost that we need to get from this project. If we are not getting at least 7.14 percentage, then we should really discontinue the project. This WACC also talks about the baseline that at least we need to get. So if we're getting more than 7.14 percentage, that's really good because at least we are able to bear the cost. If it's less than 7.14 percentage, we should fail our project. Then moving on to the next slide. So now moving on to the next slide, that is projected cash flow. Cash flow is nothing but the money, the cash that is coming in and going out. So every business runs on cash flow, right? Now let's break down how this project generates and manages money over 5 years. So as we can see on year zero, our 5 million is the infrastructure and 1 million is working capital and research and development is 50,000. So as we were talking, 6.50 was our initial investment, which is going out. So that's why we have in bracket that also means outflow of cash. So in year zero, we didn't had any sales. We had zero number of clients. Then we go to the year one, we see increase of our clients direct to 200, then year 2 to 300, and then to 400, and then gradually decrease to 350 and 250. So as our clients can be seen increasing, same way our total income has also been increasing from 5 lakh to 7 lakh 50,000, then 8 lakh 80,000. And at the same way, if we see our projected cash flow at the final after adjusting all our fixed cost and the variable cost is something that changes according to the percentage, and the fixed cost which remains same. And here our fixed cost is marketing cost, that is 5 lakhs. And now, as we can see, we have a projected cash flow increasing. And also at the end year, fifth year, we have also release of working capital that has increased our cash flow. Working capital release is at the year five, we are ending of the project, so we would be releasing 1 lakh of our working capital, and also the salvage value. The salvage value is for the cost that we're going to get after selling our helicopters and the assets, because after that we are closing up our project after 5 years. So if we talk about the key, we're talking about the key results. So our key activities really is talking about we have positive cash flow. Now we would be talking about this two. We're going to use these two important metrics that are NPV and payback period, which are really important metrics or tools that is used to decide if the investment is worth to invest or not. So starting, we're going to start with NP, or vice versa. Let's start with payback period. So payback period is nothing but it talks about how fast we're going to recover our investment. So initially we can see we invested 6.5 million. So here payback period means how fast we are going to recover that. So if we go with the simple payback period, that is 3 years, but here we are looking for the discounted payback period, which talks about the real value of the money, which is more of considering the inflation and everything, the real market context. So the project recovers its initial investment in 3 years and 8 months, and by the end of year three, 8,86,499, as you can see, is still needed to break even. And it was the year four the project generated 1.3 million in discounted cash flow, which was enough to cover the remaining amount. And dividing the shortfall by daily return, giving 249 days or about 8 months. This means the investment is going to fully recover in 3 years and 8 months. So a positive NPV means it's a well generating investment. After 3 years and 8 months, whatsoever money is coming in, that's a profit, because in 3 years and 8 months we are covering our break-even point. We are covering our initial investment. Now talking about the next metrics, NPV. So again, this NPV is really used key metrics for deciding the investment decision, and it talks about whether the project adds financial value or not. It gives the context of the net current, like it's the current value of the cash inflow and outflow, and give you the idea, has your company made profit comparing to the initial investment you have done. So let's go to the calculation of NPV. Summing the discounted value of all future cash flows give us total present value of 8.85 million, and we started our investment in 6.5 million. So after subtracting the initial investment, that is 6.5 million, with the NPV of the current value, that is 8.85, we are getting 2.79 million. That's a profit that the company is generating extra, which gives a thumbs up for which gives thumbs up by the NPV, which says we can go ahead with this project. Now we would be also checking NPV and WACC at historic rate, that is 18%. So when we are comparing our NPV and payback period with the previous WACC, that was 7.14%, and right now it's 18%. So we could see our NPV is 606K. So this is because, so since our initial investment remains 6.5 million, right? And this time the resulting NPV is 606K, which is lesser than the one which we got with the previous NPV, that was in million. Here we are getting in thousand, 606,000. Though it's a positive but less attractive, we should definitely go with the earlier WSCC, that was 7.14. So here we can see with the increase in WSCC, that means with increase in cost, that's really hamper our returns. Also talking about the payback period, earlier it was 3 years and 8 months. Right now we could see it's more than 4 years and 7 months. So nearly around 4 years and 7 months we are going to be break even point. And after this there would be 4 years and 7. Yeah, so the months left is 3 months only, because we were talking this project for 5 years. So not much of return that we could get if we go with this current WSCC, that is historic WSCC. So this really talks about if we have higher WSCC, it give you lesser return and also takes more time to pay back your project, your initial investment. Now moving on to the next slide. So the next is investment appraisal techniques. So whenever business consider of new project or investment, they need to determine whether this decision will be profitable or not. And we can see we're going to use these different NPV, IRR, ARR, and payback period tools to determine the same. So going to the next slide, investment, we have NPV and IRR. So starting with NPV, NPV calculates the present value of cash inflow and cash outflow using a discounted rate, whereas IRR, internal rate of return, is a discount rate that NPV of a project equal to zero. In simple terms, it represents the expected rate of return of investment. Both of these techniques has merits and demerits, advantage and disadvantage. So let's dive into it. So talking about merits of NPV, it's considered the time value of money, making it more accurate profitability. It provides a clear monetary value. It accounts for all project cash flow. And talking about the merits of IRR, it's easy to interpret as a percentage. It's effective for evaluating project for different scales and helping in ranking. Now since both have these merits, they also have demerits. So talking about disadvantage of NPV, its results are high sensitive to discount rate use. Can be complex for non-financial stakeholders to understand. Talking about the merits of IRR, it can produce multiple IRR values for project with irregular cash flows, and it also assumes that cash flows are reinvested at the IRR, which may not be realistic. If we consider for long-term investment, then NPR is really used. IR is institute and widely used, but has limitation. So in such case, NPV provides a more reliable and reliable and investment decision. Now moving on to the next appraisal investment appraisal techniques, that is ARR and discount payback period DPP. So ARR. So it measures profit by comparing or average annual accounting profit to the total investment cost, whereas discount payback period, it's similar to the traditional payback period, but here it accounts for the time value of money. It considers the inflation and difference, the real it provides you the real picture of the how long it's gonna take for you to get back money to cover your investment. Both of these techniques has merits and demerits similarly. So advantage of ARR, it's simple to calculate and easy to understand, allow quick comparison across different projects, whereas merits of DPP, discount payback period, is it improves accuracy by incorporating discounting, highlights risk, liquidity more effective than the standard payback. They both also have demerits. So demerits of ARR, it ignores cash flow and time value of money. This can be influenced by accounting principle, whereas demerits of DPP, discount payback period, is it still ignores cash flow beyond the payback period. It's more complex than the traditional payback period. And if we take the critical, which one is better, then my personal preference is DPP is better than the basic payback period for risk assessment, but still falls short of measuring long-term profitability. Now we'll go to the slide 10, which is about funding options. So what all are the funding options for this project? We can see there is equity debt, that is for long term. Then we have for short term, that is internal, which is profit, and then short term loan. In Nepal, short term loan is also known as OD, overdraft or working capital. So let's dive into each of them. So equity and debt. Equity is nothing but raising capital by selling ownership, whereas debt is borrowing money through loan, bonds, credit lines, LC, etc. Uh, Talking about the advantage of equity is no repayment burden. It's a strategic investment support that you get. It's high ideal for high growth companies and also ideal for the startups, which has high potential. Whereas considering debt is debt is more advantage for someone who has stable business, who has a fixed return, because using debt, there is always a burden that you have to pay. There is a fixed rate of interest, but the good part is this interest is tax deductible. You also have advantage of retained earnings, and there is less. The control is on your hand, whereas in equity, the control goes to the shareholders. It's divided. The ownership gets divided. Whereas in debt, no, the ownership doesn't get divided, but there's a fixed rate of interest that you need to pay. Considering for this project, the mix of both equity and debt would be a really good decision that they should go with, rather than choosing one. Going to the next slide, that is funding option for our operation, that is short-term fund and internal fund. So short-term fund is something that you have to repay within 1 year. Here we are talking about overdraft. Also we can call it as working capital needs. So advantage is quick access to fund, flexible repayments term, no ownership dilution, but there is also a disadvantage, a higher interest rates than also long-term loans. You have to do frequent renewals that can increase your cost and administrative burden. Talking about the internal fund is something like retain earning. It involves about profit. So you do profit every month or year, and then you reinvest it in your business. Though this has less disadvantage of risk, but it also has disadvantage of you will expand slowly comparing to the short term fund, because the profit are going to come in parts, not just your whole profit going at the is going to come at the same time. So overall, short-term loan provide immediate liquidity but come with repayment risk, while internal funding ensures financial stability but may limit your expansion because the return that you're going to get is going to come in parts. So a balance of mix would be a safe approach for this project. Now going on to the next. Now let's come to the bigger picture, big question. Should Sumit well invest? So let's answer this. So I think yes, and here is the reason why. We have positive NPV with 2.79 million, which ensures profitability. We have payback period at 3.8 years, which talks about that within just in 3.8 years our investment is going to return, we're gonna hit our break even point, and after this whatsoever money is coming, that's simply profit for this project. And also, what I see is the market of luxury travel is growing day by day. Market size is really big for this, and also our niche targeting customer, and we have this um, strong demand. And so definitely Sumit Rail should move forward with confidence. Thank you. So here are some working notes that I have used for this project. So we have first calculated weighted average cost of capital. This one is at the current market value 7.14, and the net cash flow, projected net cash flow, which we have already explained. Then we also calculated simple payback period and projected cash flow chart analysis. Again, we use discounted payback period. We calculated both simple payback period and discounted payback period, and then net current value at current WACC, and also we calculated at historic WACC. So NPV was calculated for both current and historic WACC. Thank you for today.